Welcome to today's explainer. Look, if you're managing institutional capital right now, or even if you're just tracking the deep underlying currents of the broader market, the data we are unpacking today is absolutely crucial for your alpha generation. We're going to conduct a high-level briefing based on the latest Nifty index performance, and what it reveals is a definitive, undeniable structural rotation in capital allocation. Here is our roadmap for today. We'll start with the core thesis, move on to validating the rally, look at the great divergence, dive into some micro-level evidence, and wrap up with a strategic outlook. Let's get right into it. Part 1. The core thesis, the shift to domestic demand. Here is the absolute bottom line for this briefing. Capital is aggressively migrating. But, and this is a really crucial distinction, liquidity isn't just exiting the broader market to park in cash. No way. What we're witnessing is a highly strategic capital rotation out of global technology services, and it's flowing straight into sectors fueled by Indian domestic consumption. We're talking hard assets, physical infrastructure, and healthcare. Make no mistake, this isn't some short-term trade. This is in alignment with massive structural tailwinds. As government capex initiatives rapidly expand the nation's infrastructure footprint, institutional capital is pivoting hard to capture this multi-year growth cycle. Moving to Part 2, validating the rally. Let's look at market health and institutional liquidity. Just take a look at this intraday trajectory for the Nifty. You can see a steady, relentless structural climb right from the opening bell. The index finished up 1.18%, with an intraday movement of about 350 points, giving us a really strong, definitive close at 23,689.60. This wasn't some speculative spike or a thin market anomaly. The data here shows sustained structural support and continuous buying pressure throughout the entire trading session. And the sheer scale of the liquidity backing this move, it's literally staggering. Against a 463 lakh crore market cap, over 41 million individual trades were executed in a single session. That generated a total turnover north of 143,000 crores. Volume of this magnitude confirms aggressive, widespread participation. This is heavily driven by large-scale institutional players repositioning their portfolios, which completely validates the fundamental depth of this current rally. Now, here's the kicker. On a day of massive market gains, the India VIX actually dropped by 0.81, settling at 18.61. When you get strong upward momentum combined with volatility compression like this, it's a textbook indicator of reduced market anxiety. Institutional investors aren't just deploying capital, they're deploying it with serious conviction. That shrinking risk premium signals a profound confidence in the underlying strength of this domestically fueled economic expansion. All right, Section 3, the Great Divergence, sector rotation in action. This is where the broader market narrative really splits in two. On one side, we're seeing sustained anxiety over a global IT spending slowdown. That's heavily driven by high Western interest rates, forcing corporate clients to slash or delay their digital transformation budgets. But counter to that, there is this profound confidence in India's domestic resilience. The domestic consumption engine, along with massive government infrastructure and defense buildouts, is running exceptionally hot right now. It creates this perfect counter-narrative, effectively insulating domestic cyclicals from the severe tech jitters that are rippling across global markets. The capital flight becomes super obvious when you look at the stark numerical contrast between sectors. Look at this. Nifty Bank surges over 672 points, entering a remarkably strong bullish trend. Conversely, Nifty IT drops 556 points, plunging deep into bearish territory. This exact inverse correlation is the classic hallmark of a major sector rotation. Liquidity is essentially being yanked out of global-facing export services and reallocated straight into the domestic credit and financial cycle, which is the core engine funding this entire infrastructure boom. And this momentum is aggressively spilling over into other cyclical sectors too. Beyond banking, metals are up over 270 points, and energy has surged 260 points. These heavy industry sectors are directly levered to the government's accelerating capex cycle. Think about it. As the domestic economy builds new roads, expands the power grid, and constructs urban centers, these resource-intensive sectors are catching the ultimate macroeconomic tailwind, and that is drawing massive institutional inflows. Which brings us to Section 4, micro-level evidence, our top movers and laggards. When we zoom in on individual equity performance, it maps perfectly to our macro thesis. Adani Enterprises surged 8.6%, functioning as a direct beneficiary of the physical infrastructure and energy transition push. CIPLA rose over 8%, which confirms the defensive strength and sustained growth potential in domestic healthcare, a sector totally insulated from global rate hikes. But then, look at the global IT majors. Infosys and Tech Mahindra are facing sharp downward pressure, dropping around 2.5%. The macro-level sector rotation is entirely confirmed by what we're seeing right here in the stock-specific price action. This rotational shift is also triggering some extreme sectoral volatility. You've got heavy industry players like NLCI India surging nearly 14% on the anticipation of massive baseline power and infrastructure demand. We're also seeing heavyweights like Bharti Airtel dominating instability and total trading value. Meanwhile, specific tech components that are facing global headwinds, like Canes, are suffering brutal 20% corrections. Look, in a polarized environment like this, passive indexing is downright dangerous. Portfolio positioning is absolutely everything right now. Capitalizing on domestic tailwinds is generating massive alpha, while lingering in global tech is leading to severe drawdowns. Finally, Section 5, Strategic Outlook. Let's talk macro risks and portfolio positioning. Now, before we address the actual strategy, we have to weigh 3 compounding macroeconomic headwinds. First up, sustained high interest rates in the US and Europe. That directly suppresses multinational corporate investment plans, which shrinks the global IT client spending pool. Second, rupee volatility creates significant headwinds, particularly impacting the dollar earnings that export-driven IT companies rely upon. And third, the ongoing dependency on China's broader economic recovery remains a fundamental wildcard that could continue to dampen overall global spending appetite and commodity pricing. So, to capitalize on this data, the institutional action plan is actually quite clear. Step 1, overweight hard assets and commodity cycle plays like steel, cement, and power. You want direct exposure to the infrastructure capex cycle. Step 2, overweight urbanization and healthcare sectors. These cater to resilient domestic consumption and represent structural defensive growth. And step 3, don't abandon IT entirely, but strictly monitor your exposure. Avoid legacy general IT consulting and screen specifically for niche firms that are successfully monetizing generative AI pipelines and integrating enterprise automation. I want to leave you with a provocative question to think about. Is your portfolio aligned with the booming domestic infrastructure cycle, or is it still trapped in the global tech slowdown? The great market rotation is well underway. The data we've explored today is overwhelmingly clear. It is time to critically reevaluate your asset allocation and make sure your capital is positioned for the structural realities of tomorrow's market, rather than the fading global tech narratives of the past. Thank you for joining me for this explainer, and I'll see you next time.